Welcome back to Book Club. Thank you for joining. Today we are going to be reading Chapter 3, Trade What You See, Market Sentiment. That's actually fucking crazy because I just lost a bunch of money because I was so stuck on trading my strategy as opposed to looking at what the market was actually doing. Lost a bunch of money. So it's crazy. It's crazy how the universe is sending me exactly what I need right now. And maybe you need it too. Who's to say? All right, Chapter 3. Trade What You See, Market Sentiment. Let's jump into it. Your goal as a technical trader is to identify what the crowd is doing and take advantage of it, without falling prey to the market's emotions. The primary technical tools for identifying sentiment are patterns and indicators, and the discussion of these tools forms the core of technical analysis and this book. However, you have two other methods of measuring sentiment. Sentiment indicators describe the market as a whole. Volume directly represents the extent of trader participation. Volume is a powerful indicator in its own right and adds confirmation to price indicators. Sentiment and volume indicators operate on the principle that the trend is your friend until the end, meaning the crowd is wrong at price extremes and simply clueless when markets are non-trending. Sentiment indicators are also called market indicators to describe the overall environment in which your specific securities are being priced and can be helpful to evaluate your securities in context and when markets are non-trending. You want to know whether your security is going up because its own qualities are inspiring demand or because the whole market is going up and your security is getting a free ride. The old saw has it that a rising tide lifts all boats. Knowing your security's place in the overall market can be handy when the market turns down because a falling tide lowers all boats too. Sentiment indicators that pertain to the entire market are like any other indicator. They're designed to forecast the upcoming behavior of the price. But remember, indicators only indicate, they don't dictate. In this chapter, I discuss a few of the 100 or so sentiment and volume indicators commonly used. Later in Chapter 1, I describe some of the characteristics of the way the human mind works to sabotage good trading decisions, and I propose using simple probability measures to overcome your own personal sentiment that arises from your thinking habits. Where market sentiment comes from and what it's good for. Charles Dow invented the very first market sentiment indicator in the early 20th century. Dow observed that rising transportation stocks, chiefly railroads, reflected robust economic conditions, also called market fundamentals, even though they're actually economic fundamentals. When transportation stocks were rising, it was because sales and earnings were rising. The price of industrial company shares would follow for the same reason, rising earnings. The transportation stocks were thus a leading indicator of overall market sentiment. The Dow Jones Company continues to track the transportation sector today in the form of the Dow Jones Transportation Average, although now it contains more than railroad companies. Other indices include the Baltic Dry Index that tracks shipping costs of major raw materials, and indeed both the DJTA and the Baltic Dry Index are highly correlated with major market indices like the Dow Industrial Average and S&P 500. In currencies, the dollar index is a proxy for all currencies against the dollar. I can summarize market fundamentals as the assessment of economic growth, the sustainability of economic growth, and confidence in government and central banks to keep the economy on a stable growth path. This is different than the fundamentals of a single security, which is a function of earnings, management, product excellence, competition, and so on. When market fundamentals line up well, you get bullish market sentiment. Just as with an individual security, sentiment is bullish when prices are moving upward in a steady and consistent way. The same thing is true of bearish sentiment. Only prices are moving downward in a steady and consistent way. Sentiment indicators are useful to confirm a trend in your security that is starting or already in place. If market sentiment indicators point to an up move and your security is also in an up move, your confidence in the trade goes up. Conversely, if market indicators point to an up move but your security isn't going along, you should consider whether your security is exceptional and whether it's worth fighting the tape. Trading contrary to what market sentiment indicators are saying. Sentiment indicators may offer guidance when trendedness collapses into non-trendedness or sideways range trading motion. This occurs during the confusing transition phases between up and down, and also between up and higher or between down and lower. Securities aren't always trending. Experts can't agree on what proportion of the time they are trending. The consensus seems to be that most securities are trading up or down about 30 to 40% of the time. The tendency for trends to collapse into lack of visible, obvious trendedness is very pronounced. The tendency for trends to collapse into lack of visible, obvious trendedness is very pronounced. The untrended transition phase is sometimes called trader's nightmare because all trend following indicators fail, and many other indicators, including bar reading and patterns, see chapters 7 through 9, deliver false signals. The absence of trendedness reflects uncertainty about either the fundamentals or whether the security's price accurately reflects the fundamentals or might be overbought or oversold. See chapter 2. The resulting sideways move in prices, called congestion, is a frustrating condition for traders. You literally don't know what the next move will be. You might as well toss a coin, which clearly violates the technical mindset of action based on reasonable expectations of gain or loss. Consulting market sentiment indicators might ride to the rescue or deliver valuable clues as to the next move in your own security. At the least, market sentiment indicators provide other factors to plug into your estimation of reasonable expectations, and may well be a deciding tipping point factor between taking action or twiddling your thumbs until the sideways move switches into a trend. Okay. Thinking outside the chart, gauging sentiment. There's a pause in that. Thinking outside the chart, gauging sentiment. You may have the inside scoop on the best stock ever, but if the entire market has a case of the collie wobbles, your best ever stock is likely to fall too. Conversely, when the market is in a manic phase, even the worst of stocks get a boost. This ebb and flow isn't only because of individuals, but also because money flows into and out of mutual funds and other institutional players like insurance companies and pension funds. All these institutions have latitude about how much to keep in cash. In a mania, they get more fully invested, and in a panic, they pull funds out of the market and into cash. Nobody knows for sure, but some percentage of any security's price move is attributable to changes in the market environment. Factors include not only the index to which it belongs, but also its size. Large cap or small cap, for example, and sector biotech, high tech, no tech. A guess is that about 25% of all price move in any single issue should be considered a function of what's going on in its index or other benchmarks to which the issue belongs. That's in normal conditions. In mania or panic, the price of your security will be far more closely related to the overall index move. Most sentiment indicators look outside the price dynamics of a particular security or index of securities for information about whether the trading crowd is humming along with expectations of normalcy or is willing to jump ship. Market indicators aren't technical indicators in the strict sense, but are consistent with the technical principle that you want to study what people do, not what they say. There are at least 30 indicators such as percentage of stocks above their 200-day moving average, see chapter 12 on moving averages, and number of stocks above the 52-week high. These indicators have their own symbols and can be charted just like the price history of individual issues. In the following sections, I review some of the more prominent sentiment indicators, monitoring investors, the bull-bear ratio. Meaningful reversals come when the majority of advisors are bullish or bearish. In other words, when everyone recognizes the trend bandwagon and has hopped on board, it's over. Investors' Intelligence Service, started more than 60 years ago, measures the balance of bullish sentiment against bearish sentiment, called the bull-bear ratio, and claims an excellent track record in predicting turning points. Note that other services have sprung up to measure bull and bear sentiment in general, in specialized sectors, and in mutual funds. You can find the bull-bear ratio in various forms on hundreds of websites and TV. Both CNBC and Bloomberg TV channels have their own versions. Rising equities are shown in green, and falling ones are shown in red. It can be mesmerizing to watch the colors change as news comes out, especially important news like central bank rate changes. Following the money, breadth, like BREADTH, breadth indicators. Okay, breadth indicators measure the degree of participation by traders in the overall market, represented by index such as the Dow and S&P 500. You can track the breadth indicators to get a feel for market sentiment. Indicators include ratio of advancing to declining issues. This indicator measures the mood of the market. Advancing issues, stocks that are reaching a higher price today than yesterday. Declining issues, stocks that are reaching lower prices. When advancers outnumber decliners, money is flowing into the market. Bulls are beating bears, sentiment is favorable. When the rally starts getting tired, the number of advancing issues declines while the number of falling issues rises. If you subtract declining issues from advancing ones, you get the advance/decline line. In the same vein, if you divide advancing issues by declining issues, you get the advance-decline ratio, abbreviated A/D. And lastly, difference between issues making new highs and new lows. The logic is the same as in the advanced decline indicator. If more stocks in an index are closing at a higher price than before, bullishness is on the rise. So if more stocks in an index are closing at higher prices than the period before, bullishness is on the rise. When a higher number are putting in new lows, supply is overwhelming demand and the mood must be bearish. Following the betting, the put-call ratio. The Chicago Board Options Exchange publishes the ratio of puts to calls, where a put is the right to sell at a specific price in the future, and traders who buy puts are bears or pessimists who think the index will fall below their set price. A call is the right to buy a set price in the future, and traders who buy calls are bulls, optimists, who think they'll profit when the market rises to and beyond their set price. Accordingly, the put-call ratio is an indicator of whether sentiment is bearish or bullish. A high put/call ratio means bears are winning. Recognize that an extreme of emotions like this is usually wrong and marks a turning point. You should start planning to do the opposite. The same line of thinking holds true for a low put/call ratio. When emotions are running strongly optimistic, watch out for an opportunity to take advantage of a change. Viewing volatility, the VIX. The Volatility Index, or VIX, is among the most popular breadth indicators today. Theoretically, you can create a volatility index for any security in which options are traded, although it takes computational expertise. Its calculation is too complicated to get into here, but for information about volatility, see Chapter 14. For your purposes, know that when the crowd is jumpy and nervous, it protects that anxiety into the future and assumes that prices will be abnormal. In other words, the crowd believes volatility will be high. When the price of VIX is high, options traders have been buying puts and selling calls on the index. They're bearish and think the market may fall. What they really think is that the risk of a fall is high and worth spending some insurance money on. When VIX is low, the market is relaxed and confident, overly confident. VIX is generally used as a contrary indicator. When VIX is either abnormally high or abnormally low, you know it's getting to the right time to trade against the crowd. A high VIX value means exactly the opposite of what it seems to mean. The bottom isn't coming, it's already in. If VIX is low, the crowd is girding its loins for a big move. When VIX is low, traders are complacent. They're projecting the same price levels or nearly the same levels into the immediate future with little variation and therefore little risk. New and improved sentiment indicators. In recent years, many new sentiment indicators have been devised. An alternative to VIX is the stress index devised by the Kansas City and Cleveland Federal Reserve banks. The Cleveland Index contains 16 indicators from all corners of the economy and financial sector, including bonds, real estate, currencies, and so on. When the stress index is high, you can expect fear to take over and market indices are at risk of a big fat sell-off. Another is from StockCharts.com, a nifty hybrid indicator named Stock Charts Technical Rank that places the performance of a stock within the context of the performance of the group to which it belongs on a technical basis, not a fundamental basis. 6 technical indicators are used, like how far the stock price is from the 200-day moving average. The S&P 500 is broken up into groups of 50 stocks each, and thus you can see instantly whether your security is a leader or a laggard in the context of its technical performance against a similar group. An original and advanced way of looking at market sentiment. Notice that sector or energy, pharmaceutical, and so on isn't the grouping principle but technical considerations. Getting the lowdown on volume. You're more confident that a price move has staying power if you know that many traders are involved in a price move and not just one or two. Volume is the term for the number of shares or contracts of a security traded in a period. Volume is the most powerful confirming indicator of a price move, and confirmation is a key concept in technical analysis. When you look at price changes, you imagine buyers demanding more of the security at ever higher prices, or sellers offering a greater supply at ever lower prices. But a price can move on a single large purchase or sale, especially if the market happens not to have many participants at that exact moment. A condition named illiquidity. In technical trading, you use volume to measure the extent of trader participation. When a price rise is accompanied by rising volume, you have confirmation that the direction is associated with participation. Volume is outright, direct evidence of demand. Similarly, if you see a price fall by a large amount, but the change isn't accompanied by a proportional change in volume, you can deduce that the price change was an aberration. Volume tells you only the number of shares or contracts traded, not the number of participants. Obviously, you can get a jump in volume that is due to only a handful of participants, and then you'll be drawing the wrong inference from high volume. You're welcome to ignore market sentiment indicators and stick to looking at your own charts, but don't ignore volume. The only non-price factor that genuinely contributes to enhancing the probability that your technical analysis is correct. Despite the occasional mishap, volume is the single best indicator to give higher probability to your identification of a trend. In this section, you can turn up your use of volume in technical analysis by considering a few top drawer indicators. These indicators tend to be among the most reliable in technical analysis. Tracking on-balance volume. On-balance volume, or OBV, is a single number representing cumulative volume. A market technician named Joe Granville devised the OBV indicator to display volume adjusted as follows. To calculate OBV, you add volume on days that the close is higher than the day before and subtract the volume on days that the price is lower than the day before. You're assuming that when the price closes higher than the day before, demand was greater than supply at each price level. Buyers had to offer higher prices to get holders to part with their shares. In OBV, You're attributing all the volume on a higher close day to net buying and all the volume on a lower close day to net selling. This assumption isn't realistic, but hang in there for another minute. See figure 3-1, which shows Apple stock daily prices are in the top part. Volume in hundreds of thousands of shares is the center of the chart, and the OBV indicator is in the bottom window of the chart. This is the chart. Okay, OBV doesn't work all the time, but a change in the indicator often precedes a change in the price. You can see how to use the OBV indicator in two instances on the chart in figure 3-1 following along. The down move. On the left side of the chart, the price is rising, as shown by the support line, but notice that volume is falling. The OBV indicator in the bottom window is falling too. This is a warning that the move is running out of participants, even though it's very early. OBV peaks in April, and the true final reversal doesn't come until October. If you waited to sell until you got confirmation from the price breaking the support line to the downside in October, you would have sold at $646.88 and covered your short sell at $385.10 in April, which is where you saw the circle, for a gain of $261.78 or 41%. How do you know to cover in April? First, you see a spike in volume as the last of the diehards sell, right? Then you see another volume spike that suggests buyers are back, and this time price rises. The rut is over. Not everyone can sell short, of course. Just consider that if you are a longtime fan of Apple stock, you could have saved yourself from a nerve-wracking 41% drop by selling at the confirmed point. You can always buy it back. The up move. Apple puts in a double bottom, see chapter 9, volume and OBV are falling. But at the right side of the chart, price and OBV are rising while volume is falling. When price rises on falling volume, it means the bulls in Apple stock are persisting. The price has surpassed the previous high or horizontal line. You should keep an eye peeled for a spike in volume that will be reflected in OBV, accompanied by a further rise in price to determine a new entry point. The divergence of price and an indicator that normally move in tandem is a wake-up call. A change in volume often predicts a change in price. The indicator is telling you something you can't see with the naked eye. In the Apple case, prices are putting in new highs, but not yet on higher volume, with the OBV not yet confirming new participation. Get ready to buy, but not quite yet. The term smart money refers to traders who see an opportunity forming, as in the Apple case, or the exhaustion of a price move ahead of the other traders. They're alert to the moment when the crowd suddenly realizes that it has taken a price too far and reacts violently in the other direction. God, violently. Okay, God. Truth to tell though, no indicator works all the time, and this one doesn't either. The OBV indicator was way early in calling the price drop and isn't actually leading as this chart ends. Even OBV inventor Granville famously missed a major bull market that started in 1982 and then persisted in saying it was a false bull for the next 14 years. Wow.